clear your throat a little bit. How's everyone? Great, great. Glad to hear. Well, look, give yourselves, if you could, a round of applause for being here. The reason I say that is it's important, obviously, as small business owners. And actually, how many small business owners do we have? Is everyone small business owner? Good. Don't be shy. I mean, soon. All right. Okay. So a little bit of the program or the seminar itself, pathways to financial management for businesses. Okay. So pathways to financial management for business is a 6-part series of financial management seminars designed to educate and empower small business owners to successfully manage the financial aspects of their businesses. These seminars will provide participants with the essential components of small business financial planning and management. Learn from experts in banking, innovative financing, and small business development for financial empowerment. Okay, specifically today is Intro to Business Financial Management. Hopefully we will be a little under 2 hours. There is going to be a small break in between, but hopefully, get some very good information from the presenter that we have today. What we're going to be focusing on today is the language of financial statements, which is very important as a small business owner or as a soon-to-be small business owner. How to read and interpret financial statements to make better business decisions. How better cash flow management can improve the financial health of a business. And lastly, the connection between the 4 financial statements. Okay? And I would like to recognize in the back of the room, we do have some sponsors as well as resources, people that you can utilize for your business as well. So in terms of sponsorships, we have M&T Bank, we have FSC First, we have the U.S. Small Business Administration, we have City First Bank, and Wells Fargo. Okay. In terms of our resource partners, we have Deidre Lee. Raise your hand, Deidre. There she is. Okay. Deidre is a business consultant with SBDC. So what she wanted to let you know is that on Tuesdays and Thursdays, Deidre, is that correct? Okay. Upstairs, 3rd floor at FSC First. Okay. And also we have Roderick Johnson. Mr. Johnson there. And he's with SBA. So he's another good resource partner to utilize. A little bit about our presenter. You should have full bio for Tiffany Davis inside your packet. If you don't, let us know. But Tiffany Davis is the owner of Washington Accounting Services, which currently serves over 1,684 clients with a retention rate of 88%. She has a Bachelor's of Science in Accounting and a Master's of Science in Management from the University of Maryland, University College. Mrs. Davis received an Achievement Award from the National Association of the Self-Employed for her business accomplishments and was invited to the White House, wait a minute, to brief President Barack Obama, all right, on healthcare and small business tax-related issues. Her expertise has been featured in several publications, including the Wall Street Journal and USA Today. Can we please give a round of applause for our presenter, Ms. Tiffany Davis?
Good morning, everyone. It is such a pleasure to be here. Just getting set up. So if everyone could, for me, take out the PowerPoint because I want you, as we start to go over, you took my clicker. As we start to go over, thank you, the presentation, if you have, notes that you want to take as we're going through, please write them. Okay, so my experience is a lot of times with the information that's on there, you'll have a lot of questions. So feel free, if you have a question, we're not going to wait to the end. Ask when you have a question, write down the answer, and we'll continue on, okay? All right. So what we're going to cover today is we're going to talk about what's cash accounting. Has anyone heard of cash accounting before? Yes? Okay. And accrual accounting? Yes? Okay. We're also going to talk about cash flow. So we've heard the statement, cash flow, right? What do you think that means? Yeah, speak louder. It's early. What does cash flow mean? Okay. What else? What do you think? Revenue versus expenses. Okay. What else? Anything else? I'm not going to tell you right or wrong. You're going to find out whether or not you're right or wrong. Okay. We're also going to talk about balance sheets. So what is that? What's the information that's on there? Okay. Also income statements. And we're going to talk about why all of this is important. Okay. And so you're probably saying, okay, well, I know I'm in business. I know I got to know these things, but why do I really need to know them? Okay. Because sometimes you don't understand when someone tells you you should know this, but why? Why is it important? Why is it going to affect me and the business that I'm doing? So we're going to talk about that as well. What are fixed assets? Have you heard this term before? What are fixed assets? What do you think they are? They're not things that are fixed in the ground. I've heard that before. What are fixed assets? Have any idea? Assets that don't change in value. Okay. Anything else? So we're going to talk about that because that's important because this adds value. And then we're going to talk about business accounts. Okay. What you should have, what you shouldn't have, what you should do, and what you shouldn't do. Okay. So the first thing, cash accounting. Cash accounting is an accounting method where the receipts are recorded when they are received, as well as expenses are recorded in the period that they're actually paid. So when we receive the money, it's recorded, and when we pay a bill, it's then recorded. Okay? Accrual accounting is quite the opposite. So accrual accounting is we receive an invoice today, but somebody pays it in February. When we record it when we actually receive the invoice. Okay? Doesn't matter when we receive the money. We could get the invoice today. We give a client an invoice today. We record it today. They could pay in 6 months. They could never pay us ever. We still record the money. In the same sense, you get a bill today. I got my Verizon bill today, but it's not due until February, right? I record the expense that I had to pay Verizon today, not in February, okay? Does that make sense? Okay, so cash accounting is what? Yes, but what's the important part of it? When it happens, okay? And with accrual accounting, what's that? When you get the bill, okay? So whether you're giving the bill to a client or getting the bill, okay? So here are some examples of both. So you purchase a new laser printer on credit card in May, and you pay $2,000 for it 2 months later. So under the cash method, we would record the $2,000 payment for the month in the month of July, the month when the money is actually paid. And on the accrual method, the $2,000 payment would be recorded in May when you take the laser printer and when you're obligated to pay for it. Okay? So again, we bought the printer. It was $2,000. We put it on our credit card. We don't pay for it until July. Under the cash method, when is it recorded? What month? July. Under the accrual method, when is it recorded? In May. Okay? So the difference. So why is this important? Why do you think this is important? You have no idea. I don't know, right? It's okay to say I don't know. That's why we're here. You don't know. Okay? So think about if this wasn't May and July, think this was December and January. Okay? We're going to use this example. May is December and July is January. Okay? So if I did the same thing, 2019 and 2020. Okay? Got it? So under the cash method, when am I recording that expense? In 2020. Okay? That means in a business world, I can't record that expense to affect this tax return, right? Okay? Under accrual method, when am I recording it? When? When am I recording the $2,000 under the accrual method? In 2019. So tax-wise, now I can write it off. I haven't even paid for the printer yet, but now I'm able to write it off. That's a benefit, right? I haven't spent no money and I get to pay less taxes. Okay, so let's think about this the other way. Instead of us buying a printer, say we were invoicing a client this $2,000. Okay, under the cash method, when do I record this income? When do I record? What month? December or January? It would be January, the cash method, because that's when they actually paid it, right? Which is good. Why? Because I don't want to pay taxes on money I haven't received yet, right? But under the accrual method, when do I record it? When do I record the $2,000 that I received? In December. Okay? So which means I'm recording that income in December even though I haven't received it. I'm going to pay taxes on that income even though I haven't received it. Okay? That's kind of bad because if they don't pay it, then I pay taxes on income that I've never received. Now, you can go back in and fix that. That is then considered bad debt. Okay, somebody defaulted, it's bad debt, and then you can write it off to correct it. Did you have a question? That they're modified. Yes, but for intro, we're not going to get that deep. Okay? You see how deep you just got? We're not going to get that deep. We want to give you a foundation. This is the point of this. We want to give you a foundation so you understand the absolute basic of what's happening. Okay? And as you go further through all of these programs, each class is going to help you further understand the topics that are going to be discussed. Okay. But yes, thank you for bringing that up. That it is more in detail to this, but again, I just want you to understand the basic. What's the difference when somebody says cash accounting? What do they mean? Are my statements done in cash? What does that mean? That means that the income was recorded when I received it. The expenses are shown when I spent it. Under accrual, it means what? It doesn't mean I necessarily received the money, but it means I sent my customer a bill. Okay? And that's reported in my income. It doesn't mean with my expenses that I actually paid these expenses out. It just means I received the bill for it. Okay? So just understanding that basic of it, I think at this point is enough. Any other questions? Yes. That's a great question. So when you're talking about altering it, it's not per invoice or per bill. Okay? The alteration comes in a year. It's all or nothing. So in January, you got to do everything the same until the end of the year. If you would like to change it, you can change it and do it differently the next year. Now, can you alter this on your own? No. Okay? You have to ask for permission from the Internal Revenue Service. Not from me, not from you, not from God. Internal Revenue Service, okay? So you do have to ask them for permission to be able to switch that over. 9 times out of 10, you're already defaulted as a cash taxpayer. Okay, so they're already assuming you're gonna do cash accounting. Everything is gonna be on a cash basis. If you wanna change that over, you do have to request to be on an accrual method. And then also, a good thought is you should always ask your accountant, show me both. Let me see what it looks like with both. Okay? We have an ability in our system to show you both. Normally, we will send you cash because that's normally what people want to see. But we do have the ability to show you both. And that may come in handy when you're talking about going to a loan officer, going to the bank, because you might want to show them both. Okay? Because in 9 times out of 10, your accrual accounting is going to look better. Okay? It's going to look a lot better than the cash. All right? Any other questions? Yes. Mm-hmm. So automatically, as a business owner and an individual, you're automatically considered on a cash basis. They think you're going to do cash accounting, you're going to report everything on a cash basis. Now, if you want to change that on an accrual basis, you have to ask them for permission. Does that answer your question? Yes? Okay. So also, individuals, a lot of people don't know this, individuals also have the option to do your tax return on an accrual basis. It's not only businesses, individuals also have a right to change that as well. Okay? So now we're going to talk about cash flow. So cash flow is the movement of money into or out of a business, a project, or a financial product. So the cash flow can be used to determine a project's rate of return or value, or it can determine problems within the business. Okay? So we want to see how liquid a business is. And this information is shown by our cash flow. Okay? And we have what's called cash flow statements, which we'll see a sample of very shortly. So as an alternative measure of the business profits, when it's believed that accrual accounting concepts do not present the economic realities, okay? So if they look at your accrual statements, okay, so we're showing what we did bill and the bills that we did get, the cash flow statement is going to tell the truth, okay? The hard truth. So we can alter the financial statements to say, do we want to show cash or accrual to look better? But our cash flow statement is always going to tell the truth. It's always going to show what's coming in or out and what we have. The cash flow statement always helps evaluate the risks within the financial product, as well as the quality of the income that's being generated if you're using an accrual counting method. So the purpose of these projections, because we always want to see what's going to happen in the future. Okay, we don't have any magic balls and we can't tell you exactly, but we can give a good estimate of what we think is going to happen. So this allows you to show key concepts of financial management. It is a key concept within your business. It helps in aiding and planning in the future, any cash requirements. So if you're looking at your projected cash flow statement and you're able to see what's coming in and out, you can also see if I'm going to be in the negative. Okay, maybe I need to change some of my expenses. I know that in the summer, I don't make as much money. So how are my expenses going to be affected? Am I going to make enough money in the winter, in the fall to cover that? Your cash flow projections are going to show you that information. It's important to ensure that the business has enough cash flow to survive. Okay, your cash flow statement is going to tell you this too. If you're not going to be able to survive, that's a problem. And you need to know that early. So this here is a sample of a monthly cash flow statement for each month. So I know in your booklet you have the slide. It may be a little small for you to read as the numbers here. But I do want to point out at the top here is where your income would go. At the top here is the months laid out for you. Through here are all the expenses that you would have throughout the business. Okay, so you have your income here, all your expenses. It would then total all of your expenses at the bottom here. And then it will show any loan payments that you've taken that you need to pay. And then it's also going to show what was your beginning balance in your bank account. And then it's going to show all of this income coming in and all of your expenses coming out. What's going to be left over in your bank account? So the first thing when I see a cash flow statement, I'm looking at the bottom to see if I see any negative numbers. Because you can bring in as much income as you want. You can have as more expenses, less expenses than you want. But I want to know, what are you going to have in the bank? What are you going to have? So this is helpful to see in present day, okay, and showing how does your business operate. Do you operate where you're paying Peter, taking from Peter to pay Paul? Is that how you operate business? But it's also helpful to see in the future as well. And this is why they're called projections. So you can do the same thing, not only month to month, but you can do it yearly as well. So up here, this is a yearly one. The only difference is that it does year 1, quarter 1, year 1, quarter 2, year 1, quarter 3, year 1, quarter 4. Okay, so instead of it being on a monthly basis, it's on a quarterly basis where you can see 3 years in one document. Okay, any question about the cash flow? Yes, sir. No, it doesn't have to. Okay, a cash flow statement can be based upon the accrual method as well. So it can be done either way. Okay. Any other questions? I cannot do anything with the picture. I'm so sorry. Any other questions? No? Okay. So we'll move right along. So we're going to talk about 10 tips in improving your cash flow. Okay? Because would you agree that this cash flow statement is very important? It's very important. Okay? Even if you don't understand everything that's on top of it, what are you going to look at? The bottom. And what's going to be the problem at the bottom? If it's red, okay? So that means it's a problem, all right? So even again, the point is not for you to fully understand how to put this together, fully understand how to do it, but understand just a little about what you're looking at. Okay? So, if anything, we're going to be looking at the bottom here and seeing if anything is in the negative. Okay? That's the most important step. And if we do see some things in the negative, then we know that we have to make some changes. So let's talk about some tips to improve the cash flow. Who has a budget? Anybody have a budget? One person, two, three, kind of four. Okay? We need a budget. Okay? This is business. This is not your personal household bills. This is a business. We need to make sure, one, we're making the money that we need to survive, and the business needs to survive, and we're not spending where we're not supposed to spend. Because the reality is, if we don't budget for the income or for the expenses, we won't have a business. Okay? So creating a budget and sticking to the budget. Next, bill your clients regularly. Okay? I can't tell you how many clients that I've seen that get so immersed in the business, providing customer service, being top rated, working the business, and don't bill the client. Okay? That's the most important thing. How are you going to get your money? So, regularly billing them and even setting up to say, you know what? Monday, Wednesday, and Friday mornings from 9 to 9:43. Okay? I'll give you 3 more minutes from the 40. 9:43. I'm going to bill my clients. I'm going to sit down. I'm going to review the work I've done. And I'm going to bill my clients. Okay? You might not need to do it 3 days a week, depending on the workflow of your business. But figure out what's good for you. Set that schedule. Don't call me between 9 and 9:43. My phone will be on Do Not Disturb because I have to bill my clients. Okay? That's how diligent you have to be. Get a deposit for your services before you begin. Before I even do anything, get a deposit. This is what construction companies do, remodeling companies do. Why do they do this? Guarantee the work? Serious about wanting the services? What else? Say that again. A level of good faith. What is it? Good. So he said reduce risk. And then he also said because they have to buy materials. Okay, so I don't want to spend my time at Home Depot buying supplies for your kitchen if you're really not going to do it. Because then maybe what if I went to Home Depot and I got the sink on sale and it was on clearance and you don't know that I bought it on clearance, but it's the same thing you wanted and I can't return it. Now it's mine. And I have to wait for another client that wants that same type of sink that I can put it in. Because I don't want the sink in the warehouse, right? That I've already bought. So again, if you're doing a service and you're offering products as well that you have to buy to be able to provide that service, get a deposit for your services. This is not only for construction companies or remodeling companies, this is for any company. Okay, if you're providing a service, you can ask for a deposit up front. So I'm going to give you an example of myself. When I do taxes, okay, it's tax season. And when people come in and drop off their forms, we do have an option that if you would like to take your preparation fees out of your refund, we have a bank that we work with that provides that service. Okay? And so nothing is required up front for you to pay because it's going to be paid for you out of the refund that you receive. But if you opt out to that service and you drop your taxes off, you have to pay for them when you drop them off. Why do you think we require them to do that? Well, think of this scenario. You drop your taxes off to me, okay? I do them. I call you and I say, you know what? I'm so sorry. That money you took out the 401k, they didn't take enough taxes out. Your tax rate went higher. You know what? I thought you were going to have business expenses, but the stuff that you gave me, it's not eligible to be written off. So now you're not getting back a refund you owe. I'm sorry. I'm just giving you the information. I don't like that. Never mind. I'm going to go somewhere else. Now, I've spent my time in thinking and trying to calculate the best outcome for you. And now you don't want to do it anymore because you didn't like what I said. Okay? That is the reason why we require when you drop it off to pay. Because it's not my fault. I'm just the messenger. Don't shoot me. I'm going to try. You're my client. I have your best interests, but I'm also going to tell you the truth, whether you like it or not. Okay? So again, not only in the product field, in the construction field where I have to buy supplies, they ask for a deposit, we expect that, but also put that same mentality on a service industry. Okay? You work very hard. You have credentials where you are. People want to go to you for a reason. They've been recommended. Okay? Put value to your service, and it will also help your cash flow because you're getting paid for stuff that you necessarily haven't done just yet. Give a discount for early payment. Okay? This is huge. If you're billing out a client $20,000 and say, hey, you know what? This is net 30. When I give you this invoice, it's due in 30 days. But you know what? If you pay it in 10 days, I'll give you 10% off. I'll give you 5% off. Is that worth getting that money a little faster? Okay? Doesn't mean you have to do this all the time. This could be an added bonus to your preferred clients. They don't have to know I'm in cash flow trouble. Okay? This is a way to help with your cash flow. Accept credit card payments. Now, 2020, if you're in business and you don't accept credit cards, you need to get out of business. Okay? Let's just keep that clear. How many times, who pays cash everywhere they go and never uses a credit card? Nobody. Who doesn't use cash at all? Anybody? Okay? A couple of us. I don't use cash at all. Okay? Who keeps at least $20 in their pocket? Okay? Do you ever use it? No. Okay? But you have it. Oh, for kids. Okay, right. For the concession stand or, whatever it is that they need. To get in a basketball game is $5 or so just a little bit. Anybody keep more, I don't know, than $100 in their wallet at a time? Why? Why not? Why don't you keep that much in your wallet? At least 100? Okay. Why? Why do you do that? Okay. In case of emergency and somebody doesn't take a credit card, why else? Habit? Habit of keeping the money there? Okay. So we can safely say the majority of the time, 95% of the time, we use a credit card. 95%. Yes? Yes? Okay. Good. So the positive thing for that when we use a credit card is one, the credit card is recording the transaction. It's important. Okay? If you were ever audited or I need to know what I spent, it's not relying on the receipt that I have. I can go to American Express. I can go to my bank account. I can go to Capital One credit card and see what it is that I have. Cash, I have to keep the receipt. Okay? And if I lose the receipt, I can't go back and find out what I spent. Our minds are thinking 20 million things, different things a day. Again, cash, what if you lose it? What's going to happen? Nothing, okay? It's gone. Goodbye. If you lose your credit card, your debit card, What happens? Boom. Hello? Loss, cancel, fraud. I didn't charge that. You got your money back. You've lost nothing but a little bit of frustration and waiting to get your card back. I can't use the card for 7 to 10 days until they send me another one. Okay? Also, with clients and using the credit card, this is a quick way for you to get your money. Okay? You offer the credit card, you actually swipe it, then guess what? How fast are you getting your money? 1 to 2 business days. It's coming right to you. So it's no longer, I don't have the cash in my account. You know what? I don't know how to pay. People can charge it. I'll pay for it in 30 days. And that's sometimes the mentality that we'll use. We don't necessarily have the cash right now, but you know what? In 30 days, I'm going to go ahead and put it on American Express and I'll pay it off next month. Guess what? Your client's going to do the same thing with you. So please make sure that you charge credit cards. Any questions? Yes. Absolutely, they're charging us a fee, and we don't want to pay for the money that people owe. Yes, that's the drawback. Okay, merchants charge us fees to be able to charge credit cards. Okay, depending on if you enter in the credit card, there's a fee. If you swipe the card, it's a lesser fee. Okay, if you use a card with a chip, it's a lesser fee than that. Okay, so depending on how you use the card is going to be the actual transaction fee that the merchant is going to charge you. You can also do the thing with an e-check. So you can get a client's routing number and account number, put that in. That's actually a lesser fee than that if they're paying over the phone. Any other questions about these 5 items? No? All right, we're going to take a little break.
All right. Are we getting some good information? All right. So we're going to do a brief, let's say 5-10 minute break. But before we do that, little housekeeping. I forgot to ask before. The business information questionnaire. Did everyone fill that out? If you have not, please do so. Okay. And we'll be back shortly. All right, are we ready for part two? Good. All right, everyone. Let's welcome back Miss Tiffany Davis again. Did everyone fill out the questionnaire? Turn in? Good. Okay. Miss Davis.
Thank you. Ready for the next half? Are you pulling out your hair yet? No, your hair is still intact. All right, perfect. Good, 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 good. All right. So let's continue on to the next 5 to complete our 10. Use your own credit card to finance purchases, but do it with ease. Okay? Don't get happy feet on the card. Okay? Why do you think that? Why? Why? And should you do this when it comes to cash flow? What is it protecting when you do this? Instead of me using my debit card to buy the $2,000 computer, let me use my credit card to buy the $2,000 computer. What's the benefit of doing that? Delaying you having to pay it until you have the cash. But how does that affect your cash flow statement? Because remember, we're talking about cash flow. How does that affect your cash flow? Okay. Keeps us looking good. So let's break that down a little bit. The cash flow statement includes what? Expenses, your expenses, and the revenue that you receive. So, if I use my debit card, is that expense going to be on my cash flow statement? Yes. If I use the credit card, is it going to be on there? No. Okay? Because this is cash that I've spent. Okay? Cash that I've spent. So if I use my debit card, that's coming out of where? My bank account, right? Okay? If I use my credit card, is my checking account affected? So then it makes my cash flow stay the same. I can charge $30,000 worth of supplies, things that I need, pay the whatever it is that you're going to do, $30,000. My cash flow is still going to have that $30,000. Okay? It makes my cash flow look better. Now, we do it with ease. Why? Don't want to fall behind. What else? I got to pay it in 30 days, okay? I just can't charge and it's gone. I got to pay it at some point in time, okay? The great thing is that maybe that 30,000 I want to break down over 6 months. I don't want to pay 30,000 right now. Let me take that 30,000, let me divide it by 6, and let me gradually use my cash flow to pay it. Okay? So not being reckless with the card, but having a plan with the card. Okay? Make sense? All right. Next one. I'm sorry, go ahead. So his question was, it still has to show up on your cash flow statement. What do you think? Absolutely. It don't disappear. We would love it to disappear, right? That would be perfect. Abracadabra, boom, it's gone. Okay? But eventually, yes, it does. Any other questions? Huh? Yes. Mm-hmm. That is correct. So he was just confirming that when we use the card, it's not showing up on the cash flow. Okay? But when we do use a debit card, it is showing up. So you're able to control what is showing on the cash flow statement and what is not. That is correct. Okay? All right, the next one. Establish a line of credit with the bank. Why is this important with our cash flow? Why do you think this is important? delay of payment, using somebody else's money. Don't we like doing that? Not using our money, using somebody else's money. Isn't that wonderful? We can pay all our bills with somebody else's money. Okay? Unfortunately, with the line of credit, we do have to pay it back. Okay? But again, with the same thing with the credit card, it's helping to control our cash flow. Okay? Now, just a little tip about the credit line. When you go to get a credit line, should you go get it when you really need it? Or should you go get it when you don't need it? When you don't. Okay? Because 9 times out of 10, when you do need it, the financial statements aren't going to say what you need them to say to get it. Because you're in distress. Okay? So the best time is to be proactive. Think about these things. Okay? So I'm going to use tax season again. Now is a great time for me to get a line of credit. Why? It's tax season. It's all types of stuff coming in right now. Would I be smart if, and this is just assuming taxes is all I do, okay? I don't do anything else. I only do taxes. That's not the truth, but for this example. Just the taxes, would it be smart for me to go get a credit line in August? My income is going, so people are still doing their taxes, yes, but are they doing their taxes as much between January and April the 15th? No. Okay. So my financials look better. I have more income. I have expenses. Everything looks good. But then in August, I don't have as much income coming in. I still have the same expenses around about, maybe less supplies, less people are working less overtime because we don't have extended time. My financials look better. Okay. So know that about your business. When do I look good? And when do I look bad? Okay. That's when you want to think about getting a line of credit. Put the cash that you have on hand in an interest earning account. Why is that important? Earn interest on what you have. Okay, keeping money in the shoebox under the bed is not working anymore. Okay? We are in business to do what? Make money, okay? And if we have money that we're not doing nothing with at the moment, should it be sitting there? What should it be doing? Making money. While you sleep, what should be happening? You should be making money. That is the goal. Yes, ma'am. That's a great question, and we're going to save that, hold that question until we start to talk about business accounts. Okay? So we're going to talk about business accounts a little later. Okay? Just hold that question. Yes, ma'am. Should you be using your debit card to purchase equipment and your personal debit? Hold that until we talk about business accounts. Okay? Hold that one too, because we're going to talk about business accounts. All right? Any other questions? No? Okay. Next, pay your outstanding bills quickly, on time, when they're due. Okay? Very important. Who pays their bills on the 1st and the 15th of the month? Anybody? Some of them? Okay. Who pays the bills when they're due? 3 days before they do. Grace period, just in case they didn't get their mail, snail, 3 days before they do. Okay. Who pays when they get the bill? Okay, I can't worry about it. I got too much stuff going on. I got to make sure it gets paid. I need the lights on. I got to see. Yes? I think I seen yes? Okay. Now, take that mentality. for what you just learned now. Is that smart? It's smart? Why is it smart? Relating to cash flow, when I receive the bill and I pay it because I don't want to forget, I got stuff to do, is that smart? Why not? More cash I could have had. Okay? So, what you do at home, you can't do this. It's going to affect your cash flow. Let's go a little further. Why would you want to give somebody money before they ask for it? Why? When you ask for it, I'm going to give it to you. You ask for it on the 15th, I'm going to give it to you on the 15th. You ask for it on the 30th, I'm going to give it to you on the 30th. Now, example, I'm going to use the electric, okay? Now, something happens, my car breaks down. I have to get it towed. You know, I've used too many AAAs this year. Now they're charging me an extra fee, okay? I didn't have to expect to pay that because AAA is supposed to be free. This is why I pay the membership. Take it to the shop. Something's under warranty, great, but this isn't. Now I got to pay this. I got to get to work. I don't have another car. Unless somebody else use it. Oh my God, I'm pulling my hair out. Can't breathe. Y'all with me? Okay. I already paid the electric bill. It's winter. It's cold. I was cooking. Had family over. I use all types of electric. Okay. They said I had the highest on the block that month. Now, I have all this other stuff that happened, that went on, that I wasn't expecting. And I need to use some of that money. If I paid that bill, I don't have the money. Too early. It's not due yet. If I would have waited, I would have had the money to handle the emergency that happened. But now what? I don't have the money to pay the bill, right? But I also have time because as business owners, we're in control. So if something unexpected happens, that means, you know what? I gotta pull up my pants and I gotta grind a little harder because now I got another week until the electric is due. Okay? That emergency that just happened, I can't wait. I don't have another week to get a car, to get this. I need my vehicle right now. If I don't get the money in another week to pay the electric bill, is my lights going to go off? Is my lights going to go off? No. What's going to happen? They're going to bill me again, right? I have a late fee, $35. Was that worth me being able to get my car running, get where I need to go to make some more money? But what if I already paid the bill? You never know what life is going to throw at you. You always be prepared. Okay? So again, paying the bill when it's due. In that situation, it'd have been different. Smecco, Petco is not going to turn off my lights. They're going to send me another bill. Then when I get the other bill, they're going to send me another bill. And it's going to be pink. Are my lights going to be off? No. Do you see where I'm going? Okay? So different things will happen. Different things can happen that you want to make sure that you're prepared for. Any questions? Nope. We're going to move on to the next one. Consider getting an expert to watch your cash flow. I have to say, out of the 10 of these, this is probably the best one. Okay? I gave you all these tips internally to help. But what better than somebody to analyze and tell you even further than what you already don't know? Okay? So we know some basic things to do, but it's always good to get somebody that knows more about money than you do. That's smart. Okay? To be able to help you to improve even more. So I mentioned the balance sheet before. And so the balance sheet represents your financial position at a certain time. Okay? It's not a period of time, it's as of a certain date. And this gives you that snapshot as of that date. So if I have a balance sheet, it's not going to say balance sheet through January 1st to January 30th. Okay? It's either going to give me the snapshot of what's going on in my business as of January 30th or January 15th or the 1st. Okay? So know that the balance sheet is a snapshot of a certain day. So there are three basic components of a balance sheet. There are assets, which are resources. There are liabilities, which are obligations. And then there's owner's equity, which is considered the net worth of the entity. Okay? So I'm going to break this down just a little bit. Assets, when I say resources of the entity, I'm talking about your checking account, your savings account, your accounts receivable, people that owe you money, employee advances that you've given to employees until the next pay date, inventory that you have, fixed assets that you own, cars, furniture, equipment, buildings. You prepaid the insurance, a security deposit on your office space. Everything I've just listed is an asset. It's considered a resource to you. It adds value to your business. Okay? A liability, obligations. Okay? What's an obligation? Something that requires payment, something that you owe. Okay? So accounts payable. This is simple things. The Verizon bill, the telephone bill, those type of things. The lease payment, small little things. Payroll liabilities. I have employees. I owe the IRS some money. I owe the state of Maryland some withholding tax that I've taken out. Okay? I owe Maryland unemployment. That's a liability. Any loans, short term, which are considered anything less than a year. Long term, anything more than a year. Note payable, mortgage payable. Okay, these are all liabilities. If I have a loan for some equipment, the equipment is an asset. It's going to be there, but the loan for it is a liability because I still owe. That is considered your obligation. Yes, ma'am. We are going to see a sample of a balance sheet very shortly. Any other questions? Okay, then we talk about equity. Equity determines the net worth. Okay, so things that would be considered equity is the net income that you have. Also, what's considered equity, what money have you put into the business? That's important. That adds value to the business. What income have you retained into the business? It's called retained earnings. So you'll see this on your balance sheet and say, what is retained earnings? But you got to read it backwards. Earnings that you have retained. Okay? That's what it means. From each year, every year that I've been in business, it tracks how much earnings you have retained. Okay? So don't read it English, read it Arabic. Okay? So it says retained earnings. I'm like, what is retained earnings? I remember she said, read it Arabic. Earnings that you've retained. Net profits carried on from year to year. Okay? So we're going to use a $5,000 example with the retained earnings. We just started our business in 2019, okay? Everybody with me? We had net income, which is our income minus our expenses, gives us our net income, okay, of $5,000. In 2020, January 1st, 2020, what is our retained earnings? $5,000. Okay? We're pulling over the earnings that we've retained from 2020. I'm sorry, thank you, 2019. Thank you. So this year, 2020, we had a loss of $3,000. Okay? We spend a little more money, we put more into the business. Things didn't add up. We had a loss of $3,000. When we go into 2021, what's our retained earnings? 2,000. Okay? It is keeping track from year to year our retained earnings, whether it's positive or whether it's negative. Okay? Yes, ma'am.
When does that, or why doesn't that turn into an asset of the business? If it's sitting in a bank account, or is it a separate?
It is not. So, good question. She was asking, why isn't the retained earnings considered an asset? Okay. So, when you think of an asset, you think about something that's tangible. Okay. Something that you can touch. There are intangible assets, things that add value, such as intellectual property. Okay, sometimes that's not tangible, but it holds value, right? Everything else, our bank account, we can literally, tangibly go get it, take the money out, put it on the bed, roll in it, put it back in the bank. Okay, tangible. But when we talk about money that we've retained over years, there's nothing to see. It's financial data. Okay, does that help? Okay. Any other questions? Yes. Can it be both as far as what? Your question was, can retained earnings be both? What's my two options? Both of what? No, because it's only considered equity. Again, it's not something that's tangible. It's nothing that you can do. So an asset is something that's tangible in reality. Okay, think of an asset something that I can touch, I can do something with, I can sell to get money if I need to because that's adding value. When we're talking about this is the money that I've retained over the years, positive and negative, can I take that and do something with it? What can I do with it? No.
Sorry, I'm thinking like he is.
It's okay. Keep on. Come on.
So what I'm saying is, maybe year to year, I take it out and put it somewhere else. But it's the way I'm
So let me just stop you. So let's think about net income. Because we're going to take a little bit farther back. Net income is recording the income for the year, the expenses for the year, and at the end of the year, this is what we were left over with. Okay? Just because my net income is $5,000, does that mean that it's $5,000 in my bank account? No. Okay? Again, this is just recording data. You see what I'm saying? This is data. So my net income is data. And what I want to do is I want to continue to record this data ongoing as long as I'm in existence. That's the earnings I've retained on the balance sheet, which is retained earnings. That's why it's not an asset. Okay? You're welcome. We didn't ask for his answer. We didn't ask you. It's like, go ahead.
Question is yes, because you just gave the concept, which is what he said, and yet the cash is actually a part of the equity in the company. So to answer your question, the question is actually yes. The cash that's in the bank is actually an asset, but it also makes up a part of your equity, because as she has up there, assets minus liability equal equity, right? So yeah, the cash is a part of the equity that's in the bank, but as a part of the concept
No.
that she
Assets equals liabilities. No. Assets equal liabilities minus equity. That's the accounting equation.
All right, so when you're doing it, when I look at the balance sheet, which we're going to be looking at, right? So with that cash is an asset. That cash, when we're doing an analysis of the balance sheet, right? Then the cash may be the primary component of the equity that's in the company.
Again, what we are trying to do is to get a basic understanding of the terms that you see on your balance sheet? Okay? Is a portion of the cash in your bank account at some point retained in the data of the retained earnings? Yes, it is. Okay? But this is not what I want you to think about. The concept of retained earnings is what it is, what I just told you. Okay? And that's what I want you to understand about that. As Roderick said, the correct equation is your assets should equal your liabilities minus your equity, which you will see that on the balance sheet, which I believe is next. Well, I'm sorry, a couple of slides down. So I will show you that. But at the bottom, there's a couple of ratios that are super important that you should at least know. So your current ratio, and this actually indicates the amount of liquid assets that are available to liquid current debt, or the company's ability to meet its current obligations. So the higher that the ratio is, the greater liquidity that you have. Okay? So you take the way that you get this ratio is you take your current assets and you divide them by your current liabilities. Continued on, a couple of other ratios and things that you can do from the balance sheet is your accounts receivable turnover. So we want to know how fast are you turning over accounts receivable? How fast are you able to get your money? Okay? And the way that you calculate this is you take your net sales and divide it by your average accounts receivable. Same thing with your inventory. Are you just buying stuff up and keeping it? Or are you buying it and selling it? Are you buying unnecessary inventory? You can calculate to see what that ratio is as well as current debt, your debt ratio, and then your debt to equity ratio. So I want to take a second and go to the actual balance sheet that you will see. So again, your assets, which are listed here. And then you have the total of your assets. And then your current liabilities, any long-term liabilities. And then you see common stock, which if you're a corporation, you will have stock into the corporation. If you're a limited liability company or a sole proprietor, you're not going to have this common stock here. So that is something that's special to the corporations. But this is just a general layout. Normally in a regular balance sheet, this is all one page. Okay? It's not broken up like this, but for the sake of the slide so that you're able to see it a little better, we do have it broken up. So let's talk about statements of income. And people call this statements of income. They call it a profit and loss statement. They call it a P&L. And you know what the difference is between those names? Nothing. Okay? It's all the same thing. All right? So your income statement measures the performance between a period of time. Okay? So I can look at my income from January 1st to January 30th. I can look at my income from January 1st to January 10th. I can look at my income from January 1st to August the 15th. I can go in any span that I want to. Okay? So with the balance sheet, am I looking at my information on that day, on a day, as of this day? What did I have? With an income statement, what am I looking at? A period of time. Okay? So on the income statement, you will have your revenue. You will have your expenses. And then that will be able to show you any gains or losses that you've obtained for that time period. If you have a company that you actually buy things, or you have contractors that actually help you get the money from your clients. So, example, a construction company, remodeling company. We have to buy materials to do the job. We might not know how to put the plumbing in the floor, so we need to get this expert plumber just to dig around here and we can do the rest of it. That is considered cost of goods sold. Okay? And that actually would be in the middle right here. We'll see that on the example. So anything that is contributing to the income that we're going to receive from a client is considered the cost of goods that are ultimately sold. Okay? And we call that cost of goods sold. So we would have our revenue. We would subtract out any cost of goods sold, anything that we internally kind of bill to the client, and then we would then get our gross profit. And from there, we would subtract out any expenses that we had. So, from the income statement, like the balance sheet, there are ratios that you can use to tell you some additional information. Your profit margin. This is very important. This indicates how much net income is generated by every sales dollar. That's huge. We got to know what's the profit margin. So the way that you figure this out, you take your net income and you divide it by your net sales, which will then give you your profit margin. We also want to know what's our gross profit margin. Okay, how much of every net sales dollar that we have actually results in gross profit? Are we making any money? Are we really making any money? And you take that, take your net sales, you subtract any cost of goods sold that you may have, and then divide that by net sales. Operating expenses as a percentage of sales. This is important. This indicates how much of every net sales dollar was used for operating expenses. Okay? Depending on how high or low this ratio is, it'll tell you a lot. Are you spending too much? Are you charging enough? It may not be your spending. It may be that you're devaluing your service. Okay? So this will also help. Oops. So the income statement, you'll see, you'll have always your revenues first. If you do have cost of goods sold, they will be listed here. And then you'll have your gross profit. You'll have all of your expenses. And then at the end, it'll show you your net income. Again, this is the statement of income, sometimes also called the profit and loss statement, or you hear somebody say the P&L statement. Any questions? Okay. Should your cost of goods sold be the largest denominator of your success? Why do you think that would be so important? So if you are in this sense, no, okay? But I understand where you're going. So if you have a product, should you ultimately be looking at, okay, what is it going to take for me to provide this product or this service and product, okay? So before you even get to calculating and you already started the business and then looking at that, you should, before you even started the business, you understand what I'm saying? You're looking at this. So if it's going to cost me, I don't know, say I do gift baskets, okay? We'll use gift baskets. I sell gift baskets. And inside, how much is it going to take in product for me to fill the gift basket. Okay, that's important because that's cost of goods sold. Okay, and then how much time is it going to take me to make the gift baskets? Okay, that is ultimately in your head as a cost of goods sold. Okay, any packaging that I have to pay for, postage, okay, to mail the gift baskets, okay, all of those costs are a part of that cost of goods sold. Okay, now that will tell you, because you always want to know what's your break even point. Okay, not only in the product itself, but in business as a whole. Okay, how much money do I need to make just to break even, just to pay the bills, just to be not in the black or the red, but in the middle. Okay, so yes, is that important in determining that? Absolutely. Okay, but on a project by project base, you would want to look at that as well to say, hey, are they buying more supplies than we actually budgeted for? Again, having a budget, okay, in that circumstance. Just, if that happens, that may tell you something. Somebody messed up on something and they didn't tell me. Okay, somebody put something in the trash and bought something else, and now why are we spending so much more money? So yes, it's definitely going to tell you a lot of information, but should it be, and I understood where you were going with that to try to figure out, okay, how should I sell this to people? How do I figure that out? That's how you would then figure that out. Okay. And then in addition to even looking at that for the product, you also want to think about, okay, well, what are my expenses? Because a part of your operating expenses, the lights, the this, the that, have to go into that product too. Well, that's your fixed. Okay, so those operating are your fixed expenses. Everything else that we talked about, all of those things, they can vary, which is your variable expense. Okay? Any other questions? Yes. Mm-hmm. So his question was, if he purchases some equipment that he's going to use and that he's going to continue to use in the business, not only on this in particular customer, but more customers in the future. Where does that go? Is that considered a cost of goods sold? And that's a great question. No, that's an asset. You've now added value to your business, okay? And that will go under equipment and machinery. Okay? Any questions? Any other questions? Okay, so why is this all important? Why do you think this is important? So you can know what's going on. I mean, that is just the best answer. So you can know what's going on. Why else is this important? If you're moving in the right direction. I want to know if I'm wasting money. And if I'm wasting money now, not a year from now, not with the dream that I think. Okay, I want to know right now. So let's look at some other reasons why this is important. Monitor your progress. We said that. Prepare accurate financial statements. If somebody really wants to know what you're doing, if a bank wants to invest in you, if an investor wants to invest in you, if your mom and dad want to invest in you, people want to know. And you think if you go to friends and family with financial statements, one, that's going to tell them you're serious. Oh, look, she ain't playing about this stuff. This is what she made. This is the expenses she had. This is what she's projecting. They're going to look at you like, yes, I'm going to give you that check right now. Okay? Instead of coming in their living room and saying, I have an idea. Help me. Okay? Sometimes it's the perception. Allow for effective planning. So you know what you can do. You know whether or not you can buy that piece of equipment that you're going to use for client and client and client. Am I going to have that money to be able to do that? Or do I need to start to reach out to try to get the money to do that? it looks like my business is rising. So I need to plan for it. Of course, taxes. How are you going to prepare your taxes if you don't have your financial information? You can't. You can guess. It's not accurate. And then it also helps in aid and risk management. Okay? We always like to know bad things before they happen, right? That would be great. This is one tool to kind of show you before it actually happens. So, all this talk about income, expenses, and assets, and all this great stuff, what do I need to keep? Okay? I know I have all this stuff, but what do I need to keep track of? Cash register tapes when it comes to income. Okay? Any transaction, you're taking a credit card from a client, you keep those receipts. The ones that they sign, you keep those receipts. Bank deposit slips. Okay? So now people don't pay in cash too much, or sometimes they may write in a check. Your deposit slip, you want to keep that. A lot of times now, we're taking pictures of checks. Okay? We're not even going to the bank. We're taking pictures of checks. So once that check actually clears, go online, print that out. Okay? You'll have a copy of the cash check. Any receipt books, if you do have them. So if you do have a client that pays in cash, you want to keep a receipt book. It's only $5 at Staples. Okay? Just to give them that receipt, and you also have track of that. Any invoices you send. Okay? You email them to clients, you mail them to clients, you also keep a copy in your records. Please know that your bank account and showing deposits is not enough proof to the IRS that that was income. Okay? So you need to actually show that you invoice the clients as well. Credit cards, charge slips, and then any form 1099 miscellaneous that you receive that show income that you've retained from different clients as well. When it comes to expenses, you should keep canceled checks. Why do you think you should keep canceled checks and not a copy of the check that you wrote? It hasn't been cashed. Anybody can write a check and make a copy of it, yes? Okay? But we want to actually show that we wrote the check, we paid the individual that it was endorsed to, and they actually cashed it. Okay? Cash register receipts, of course, that you get when you purchase something. 9 times out of 10, your cash register, credit card receipt is what? What type of paper is the receipt? Carbon. Okay? What happens to carbon over time? It fades. When do you think the Internal Revenue Service, State of Maryland, whoever your state taxing authority is coming after you? Is it the month after you've paid it? When is it? Years later. And what happens to that carbon receipt? It's faded. You can't see it. Okay? So, if you have carbon receipts, make copies of it. So, that Monday, Wednesday, Friday from 9 to 9:43 that you're invoicing, add this to the list. Making copies of your carbon receipts. Because over time, they fade. And especially if they're in a file, okay? Then if you start to move around, they get lines in them, okay? They're not legible. So make a copy of them or either scan them in. Your account statements. So even if I don't have the receipt, I've charged it on my debit card or I've used a credit card statement, you have that statement if you don't have the receipt. Now, just because it's going to be on your statement, does that mean you shouldn't keep the receipt? No. You keep both. Everything. Invoices that you receive from vendors, you want to keep those as well. And then any petty cash slips for any small cash things. Someone's going to the store, you give them a couple of dollars for petty cash to purchase something. You want to keep those receipts as well. Fixed assets, we've kind of talked about this throughout the day, but these are property that you own, equipment, fixtures, furnitures. It can be intangible things. Maybe you developed a software that's considered a fixed asset. These things are normally durable. They last longer than 1 year, and they will be depreciated on your tax returns, and also show on the income statement depreciation as an expense, and also it shows on your balance sheet because then it subtracts from the value of the asset. Okay, so if you have a piece of equipment that you purchased for $10,000 on your balance sheet, right? It's on the balance sheet because it's an asset. On the balance sheet as well, it's going to track the depreciation of it, okay? Because eventually, it's not going to be any good, okay? For whatever reason, it's going to break down because it's old. It's going to be outdated because it's something new and better. And so the balance sheet then tracks that value as well, in the hopes that hopefully it lasts longer, but if not, you reserve the right to buy a new one. So what do you want to keep when it comes to assets that you actually purchase? Okay, so you want to keep track of course, the date that you purchased the asset and what the purpose was. That should be on the receipt. If it's not, just take time to write it down. Also, the price of the asset, how much you paid for it, is important. The method that you acquired the asset. Did you pay for it in cash? Did you pay a credit card, a check? And then any cost improvements and upgrades that you do to the asset, you want to also keep track of that. So if you improve the asset, now the asset is worth more. Okay, people do this a lot of times with vehicles, right? You buy a vehicle and it has stock rims and you want it to look good. You put some custom rims on there. Okay, now you're improving the value of the asset. So during the life of the asset, what do you want to record? Any deductions that you have taken for depreciation, this should be on your tax return. It should be present in your financial statements. So you should have that information because we want to see, okay, what's the value continuing on? There is the depreciation method called Section 179, which can be taken on the tax return as well. We're not going to go too much into the depreciation types because there are quite a few, but definitely talk with your tax professional or your accountant because different ways may benefit you more, which depends on how much net income, expenses, other income that you may have. That you may not need to take the greatest depreciation. You might only need to just take a little bit because you have enough to off balance it. Or maybe you don't have enough to off balance it and we need to take more depreciation just to make the tax situation a little better. The great thing is a lot of times with dealing with the banks, they will add back some depreciation for you. So it won't necessarily affect your income too much because this is more of a taxation benefit that you receive. Deductions taken for casualty loss. So if something happens to it, it's insured. You want to keep all of that information as well if you're reimbursed by an insurance company for those costs. And then how you've used the asset during its useful life. You want to keep a record of that as well. Now, when it's time to get rid of the asset, you want to record and make sure you know the date that you sold the asset, or it disposed of itself. That means it just broke, okay, and I had to buy a new one. How you disposed of the asset. Did you give it away to somebody? Or did you give it to charity? Or did you sell it? And if you sold it, what was the price that you sold it for? If you sold it, what was the price that you sold it for? Because that's important. We have to determine whether or not there was a gain or was there a loss. And unfortunately, if there's a gain, then we have to add that as income. And then any expenses relating to the sale of the asset. So a good example of this, maybe you have a rental property, okay? And you're putting expenses to get it sold. They're requiring, oh, the windows are old. Oh, this, that, and the other. These are additional expenses that you probably wouldn't have spent if you just had kept it. That can add into the expenses and the disposition of the property. So all this stuff that I named, how long should you keep them? What do you think? Forever. 7 years? What the- Y'all got the paper in front of you. You can see what it says. Yes, 7 years. Now, you absolutely want to keep things for 7 years. I'll tell you with income tax returns, it can only go back 3 years from the date that they were filed to amend or fix anything. Okay? So a lot of people think, oh, well, I only need to keep them have to do on that side of it because you've already purchased it. But in the state of Maryland, we have things that we have a return that we file called an annual report. They just changed the name of it last year. It used to be called the personal property return. And this report in the state of Maryland lets you document any personal assets that you're using for business use. Okay, so that's when you would then record those assets. It would also be recorded on your financial statements as well, again, because these are personal assets that you've then put in. There is a way for us accountants to accommodate and show on the financial statements that that was something personally done and now it's an asset of the business. I would go even further as just creating a document of saying that either you're donating or this is the value of the asset that you are giving to company ABC and show that as a loan to be paid in a future date. Again, you taking out money from the business is then not going to be taxed. It's going to be repaying the loan of the asset. It's a lot of different ways that it could be done. Again, emphasizing why you need an expert. Because yes, I know what I need to be able to do it, but what's the best way to do it? And there's not one right way. Okay? So this is not one way in and one way out. This is a mountain. Okay? And there's paths every way to get down the mountain. We just got to figure out which path is yours. Oh, pathways. That was cute. Okay. Any questions? Didn't even know. Can you buy personal equipment? I mean, will personally buy equipment and lease it to the business? Yes. hmm That would be the same way U-Haul is leasing a truck for your business. If you personally, so say you personally have a box truck that I've used because, we had to do a lot of moving the kids and family around, so we just went and bought a box truck. And now, you know what? I'm tired of working for y'all. I'm going to start my own moving company. Yes. Okay. Any other questions? Both. Okay, you have a phone and a computer used for business and personal use. Well, the hope is that you would have a computer designated to business and a computer designated that you use for personal use. A lot of times that doesn't, unfortunately, it doesn't happen. Depending on the situation, we can then take the asset and say it's used 50% for personal and 50% for business. Any asset, I do that a lot with vehicles, okay? Because a lot of times we're using vehicles for business use, but we're also using it for personal use. If you have two vehicles, I try to stress to say, you know what, only use this vehicle for business, don't use this one for business. So it makes it easier to determine because business use is very important. But if so, I would try your best to separate it. But if not, then we try to determine what's half and half. On that instance with a laptop, we would have to look at, okay, well, how often are you doing business a week? Okay, how many hours? Because even though it's a laptop and I use it for both, it doesn't necessarily mean it's 50-50. Because you can only be doing business 10 hours a week. And on your laptop, 40, okay? So then your percentage then changes, okay? Any other questions? Okay. Well, it's been one more. Mm-hmm. Um, on your financial statements, would you need to account for them separately? Yes. Okay. Taxation, would you have to account for them separately? Yes. In the state of Maryland, you would have to show, somebody would have to own it. Okay. And then you would have to show that another business has access to it to be able to use it. Okay. Should you buy equipment before you register your business? If you plan to buy the equipment under the business, with the business, then you need to register your business first because you're not even a business. If you're going to purchase equipment because you're going to purchase it for the business, then it doesn't matter whether or not you've opened the business or not. Okay? You're welcome. Any other questions? All right. It's been a pleasure. Thank you. My information is on the last slide. Feel free to, if you have any additional questions, shoot me an email. And it's been a pleasure.
All right. Did we learn a lot today? Yeah. Who's going to leave here with a better understanding than when they first came in? Yeah. And that's what Pathways is about. Pathways to financial management for your businesses. I did not, and apologies, you guys don't know who this guy with the microphone is up here talking and introducing people. Well, my name is Andre Plummer, and I'm the Financial Services Program Manager for the Economic Development Corporation, which is upstairs, third floor. Okay? So in Prince George's County, lovely county we have here, but we also are interested in our small businesses winning. Your win is a win for us. So it's very important for you all to utilize the resources that are here. Please network. I want you to turn around and look at these people in the back of the room. They're not statues or wallpaper. These are your resources. And if I could, Alicia, do you coming up? Yes, we'll do that. You can come on. So we have in the back of the room FSC first. You can say your names. I think. And from the Economic Development Corporation, there's a couple people in the room.
Or as an LLC, just as the presenter suggested. But you would need those documents first, as well as, information about a tax. So we have accounts that you can open with as little as $25. There is an average daily balance. So again, us asking those nosy questions so that we're both comfortable with each other and moving forward, we would then determine what your balance needs to be in order so that you're maintaining the account for free, essentially. Thank you.
Don't be shy. If there's any other questions or any other follow-ups, please network and ask those questions.
And so we're just going to close up the program here. You'll have time to network and talk to each other and the resource partners here. We have the SBA is also a resource partner, as we mentioned earlier, that does financing programs. FSD has a variety of financing programs that they work with the SBA on. And we have the Small Business Development Center, which has also been our partner and in the room here today. And they can actually provide one-on-one counseling sessions to you as well and provide some technical assistance. So I just wanted to make sure people were aware of those, as well as SCORE is one of our partners in this program as well. And SCORE are retired executives that actually provide service back to the community. They have had a successful career and give back. And next week, we will be having one of the SCORE counselors and an expert in finance and CPA background come and do the next session. So you are here for the Pathways to Financial Management for Business. And so next week we'll be looking at you're going to be embracing the financial elements of your business plan. How many of you actually have a business plan? Okay. So if you don't have a business plan, SCORE also has counselors, and we can help you. We'll try and bring a template of what a business plan would look like. And so next week, you're going to get the financial elements that go into the business plan. So that's all very key. And then we have many more sessions upcoming. We're going to do a deeper dive into accounting, a deeper dive into understanding credit, business credit versus personal credit. And we're also going to be looking at matchmaking your needs, understanding what kind of financial tools are out there for you and which one may be the right one for you and at what time. And then we're going to go into some other things about improving your chances to get to a yes. So if you are trying to get financing of some kind or a line of credit, what you may need. And we've discussed many of the elements that you may need and that are part of your business plan today. And then last but not least, on April 30th, we're going to have the lender matchmaking event. So that's when M&T Bank and other lenders will be in the room to work with you and to meet with you one-on-one based upon what your needs are. So thank you for investing time to be here today. We really appreciate it. And we're here to help you. So please think of Prince George's County Economic Development Corporation as your partner as you move forward. Thank you.